Good afternoon. Welcome back to the afternoon session. And that's what they call the graveyard shift. Since we did not feed you, so I guess you are quite alert right now to begin our section. Now, in the morning, the two sessions in the morning, we've heard quite a lot about Hong Kong's uniqueness, our intermediary role between mainland intermediating capital from the West and mainland China. Now it's been discussed quite a bit, notwithstanding the talk about the decoupling. We actually found that there's actually more coupling in terms of more international capital going to the mainland and also mainland investors investing overseas. Now that's quite a lot have been quoted on the turnover in the bond market, in the northbound and the southbound. Just two figures to throw at it. The cumulative net buy of the Stock Connect of international investors on the mainland is, over these years, is 1.5 trillion renminbi. And the cumulative net buy of the bonds, northbound bond, is also around that amount. And the southbound, in terms of southbound, and of course, the mainland investors investing in the Hong Kong stock market, in terms of turnover, it's more than 300% up from what it was in 2019. And they regularly account for something like 12 to 13% of our daily turnover. So these two connects, along with the newest Wealth Connect schemes, are the first of this kind in this world to connect mainland capital to the rest of the world. So in this session, plan to go a step further to explore ways and means to deepen these connect schemes and our role as a risk management hub. We will be hearing from industry leaders, you see on the panel, of how they fit into the China strategy, and also not only using Hong Kong as a hub for China, connecting to China, but also to other APAC centers. More importantly, we look at the risks the global firms are navigating in expanding their footprint onshore and offshore China in a year that stands out as one that are full of business opportunities, but also fraught with geopolitical, operational, and regulatory risk. And we also have heard from this morning that if you become more close to China and just the international financial center for China, you also lose something as well. As China expands, then it makes no difference whether you're based in Hong Kong or in Shanghai. So I want to hear from industry leaders how we should also maintain our internationalness. Now, panelists in this session needs no introduction. On my left, Filippo Gori, CEO of JPM Asia Pacific. Angel CEO of Citi Hong Kong and Macau. On the screen is Huang Haizhou, hi from Beijing, MD and Head of Equities for CICC, and Rico Leung, ED in charge of Supervision of Markets. The session will be divided into three parts, with the first part focused on these firms, your China strategy. So for more than 30 years since opening, global investment banks or asset managers are allowed something like 33% at most of the equity of their investment in joint venture securities firms or asset management firm. But China has speeded up its opening. That again, opposite to what the rhetoric about decoupling, by approving wholly owned investment banks and asset management company. And that has prompted a lot of huge investment. So in this round, I would like to ask the firms here, your high-level China strategies and what it means for Hong Kong. Let's start with Filippo. JP Morgan is celebrating its first 100 years doing business in China with a big push on your presence onshore. So reflecting on the journey and looking forward to the next centennial, as an investment bank having a regional head office in Hong Kong, can you share with us your views on the position of Hong Kong, where you got to here with your China strategy, and what are your hopes and for your mainland strategy, and also how do you use Hong Kong in achieving that strategy? So what especially focusing on what are you looking for in this relationship between Hong Kong and China?
Thank you very much, Julia, and good afternoon, everyone. As you pointed out, we just celebrated our centenary in the mainland, but we are also about to celebrate our centenary in Hong Kong, which is going to be in 2024. So we see this as a very symbiotic relationship. As you pointed out, we have worked over the last few years to reach, since it became possible, 100% ownership of the various entities in the mainland. We have a bank which we have owned 100% for quite some time. We are now, we have the future and options entity, 100% of it. We own 100% of the security company, and we are in the process of going through, hopefully, achieving 100% of our asset management company. And if you think about it that way, those are the full licenses that are necessary pretty much to do business everywhere in the world, and are the same licenses that we have in Hong Kong. So in that sense, the strategy is relatively simple, which is go after, try to get to 100% of the entities, so it's easier in a certain extent to control your own destiny and follow the clients. So we're doing this because there is clearly a need from a client point of view to be there in the mainland. So where does this position Hong Kong in that sense? For us, it is, and it remains, as you pointed out, first of all, the regional headquarters. So we run the region from Hong Kong. The 17 countries that we control, the regional headquarters is based here in Hong Kong. But also for us, it is and remains the gateway to China, in the sense that we see this as a symbiotic relationship between Hong Kong and the mainland, and we see the opportunity to grow in both at the same time as one of the key focus for us for the past few years and in the future. And we don't tend to segregate. Often people are quite interested into seeing how we segregate the business that we do in one part and in the other. And in reality, for us, we try to look at it holistically, because we think that that's the way that it makes the most sense to maximize the support that we can give to our clients and to our colleagues. What's unique, in my opinion, of Hong Kong, and I'm sure others have touched upon it this morning, is for us, it's at the center of that ecosystem that makes it an international financial hub, and it makes a lot of sense to be based here. It's an ecosystem that is based on certainty of law, that is based on availability of talent, that is based on access products to the mainland, but also is based on a regulatory framework that, in my opinion, and that's one of the unicity of Hong Kong, creates the bridge between the mainland and the rest of the world. And that unicity of this ecosystem makes it so compelling for us. And when you say, what are we looking for? We're looking for to be able to keep on building further obviously into the mainland, but in Hong Kong as well, by using this IFC status that for us, it's so dear.
Thanks. Citibank has always operated on a dual hub in Asia. And there has been a shift in your global strategy earlier this year to exit consumer banking in some markets. But Citigroup retains its retail bank operations and remains an institutional hub in Hong Kong to complement its presence in other global hubs. Now, we see continued investments that Citi is making in Hong Kong, but also a big push to Wealth Management Connect. Now, it seems that the China focus with Hong Kong remains, but could you share with us your mainland strategy and see how that dovetails with your institutional business?
Thank you, Julia. by no means is a race, but I will mention it anyway. We established our business in both China and Hong Kong since 1902. So we are about to celebrate 120 years next year in both places. So we do have a, important footings, in both China and Hong Kong. Julia, you mentioned about our strategy refresh, on our consumer business in Asia Pacific, but that doesn't change our commitment in Hong Kong. As you rightly pointed out, in fact, this strategy refresh is a capital optimization exercise. Basically is to put the capital in places where we have the highest return. And obviously, the Hong Kong wealth business and institutional business is the one that generate, a good return, for the firm. And therefore, we are doubling down our investment in Hong Kong. When we talk about the China strategy, nowadays, we actually don't term it like that. We actually look at a greater China strategy rather than a China and Hong Kong strategy. Obviously, from a strategy perspective, because of the unique position of Hong Kong and China, we have to look at it together. But from an execution and implementation perspective, we do have different execution and implementation plan, for the different countries. And therefore, again, you have pointed out that we have decided to exit our consumer business in mainland China, but remains, in Hong Kong. Mainly is because, the retail business needs the scale, to generate the impact and the return. Where in China, doing a retail business is very difficult, to build scale versus, the local giant Chinese banks. So it's pretty much a strategic decision of that. But let me, share with you some of the key strategy. You asked me about how to dovetail, the China strategy dovetail into the Hong Kong strategy. Like what Filippo said, we also see Hong Kong, as a very strategic market because, Hong Kong is the gateway to China. And it is not just introducing, foreign investor into China, and nowadays is actually also helping our China customer, our clients, to go outside of China. So the first strategy in China, in the institutional side, is to help, we call it in Chinese, 走進去,走出來,引進來,走出去. So it's basically introducing, the company into China as well as helping China Corp to go out of China. And I think Hong Kong is uniquely placed, to do exactly that. And for a firm like ourselves, with 120 years experience operating in China, I think, we are also very well positioned to do that. We actually banked 70% of the top 500 Fortune company in China. So the other, strategy I want to mention is around security services, because another group of customers that we serve a lot is financial institution. And besides our peer banks, we also serve, the non-bank FI, including the asset management company as well as insurance company, whereby also Filippo also mentioned that, a lot of the licensing and the opening of the China market, to these non-bank financial institution will, generate a lot of opportunities, for us to service them. So one of the examples is our security services business, which is basically a platform and infrastructure business, helping, these clients to manage the asset and do settlement. So this is one of the area that we put a lot of focus in. And we are one of the first major global custodian in China, helping to do onshore fund custodian services nowadays. So this is the second strategy. And the third strategy I would mention is about wealth management. The wealth accumulation rate, in China is huge. Some articles and research, was pointing to, the 2/3, of the world's wealth growth will come from China. And also 50% of the wealth growth, in China will be managed in Hong Kong. So this is talking about big number. And I think, the reasons why Hong Kong is well positioned, to surface, this particular segment is because of our depth of the market, the breadth of the product that we are offering, as well as the very mature infrastructure, may it be accountant, legal, regulator, which is very much needed, to protect the investors' interest. In Hong Kong is world class. So I don't see any reasons, why Hong Kong cannot contribute more continuously in this region.
Thanks. Thanks. Let's move to CICC. In terms of years of founding, you have 100 years, 120 years, and Haizhou, I think the firm you represent, CICC, was founded in 1997. So you're a little brother. Can you, but you had a very unique strategy, clear strategy to go global from from what I can tell in the very early days you set up internationally, helping Chinese firms to go global with their listing in Hong Kong, and now you're a giant in that area, and M&As overseas, using Hong Kong as base. Now that China is pretty open, now that China is also allowing JP Morgan and other investment banks to set up investment banking on the mainland, you are faced with more competition. And how do you see that journey, and how strategically, how are you positioning yourself in the next 10 years?
Julia, well, thank you so much for inviting me. I'm sorry I can't be with you, in Hong Kong, although I wish very much. Before the pandemic crisis, I think that typically took a one-day trip between Hong Kong and Beijing, and did that quite often. And so I have been living in Hong Kong with my family since 2005. So I think that the question you raised are very important. CICC, among the institutions you talked about in the panel, I think we're the youngest. We are only in the 20s in a way, but we were born in Hong Kong actually back in 1995. So we are 26 years old as of now, very young. Hong Kong, we always regard Hong Kong as not only gateway for China. For international capital into China, or Chinese capital from through Hong Kong to global platform. To us, I think Hong Kong is our birthplace, and so we operate in Hong Kong first, and then we start to expand it into mainland China. In the IPO area, of course, we did a lot of mega IPOs in Hong Kong market, and also often together with JP Morgan, Citi, and other international players. I think that the Chinese capital market has a huge room to grow, and I certainly at the CICC we welcome the opportunity to continue to collaborate with with the colleagues from other institutions, and also continue to basically to support Hong Kong as an international financial center, and that's vitally important for our business. Given that our name is called China International Capital Corporation, so we're very much operating international business. For example, in the QFII area, I think we have over 50% market share. Much of the QFII business also is connected through Hong Kong. But also is connected in New York and London. Another very important area, of course, is Hong Kong Shanghai Connect, Hong Kong Shenzhen Connect, for example. I think that we are the biggest service provider. We have over 10% market share, close to 20% in some area. So for that, I think that we are very proud of ourselves for being, able to connect Hong Kong with, Chinese stock exchange and Chinese investors. Hong Kong, we believe, will continue to be, as I said, a very important international financial center. So CICC has firmly committed to, grow in Hong Kong and support Hong Kong financial service, support Hong Kong as an international financial center. So we continue to bring important deals from China to Hong Kong market. We continue to serve Hong Kong local clients, and also we continue to provide service through Hong Kong for international clients. So in all those areas, I think that we think that there's a lot of room to grow. China's financial system is such that it's still dominated by the commercial banks in a way. If you look at the asset size, probably over 90% is dominated by commercial banks. So investment banking business probably account for 3%, 2 to 3% in that range. We believe there is huge room for investment banking service to continue to grow in the next decade and the decades to come. So a much healthier composition probably would be, let's say, 70% commercial bank, and investment banking industry probably will account for, let's say, 10% of the total system. That means that we have another 3 or 4 times, growth space. So in all this regard, I believe, first of all, we welcome international, institutions, colleagues, or competitors to join us, to serve both Hong Kong market and the mainland market. And secondly, I believe that China's success also depends on China continue to open up. I think that by working together with international colleagues, I think that we and also through Hong Kong, I think that we can help China to continue to open up its market, and that will create a lot of opportunities for all of us and also for Hong Kong.
Thank you. Thank you for the firm's view on their strategic approach to mainland and to Hong Kong, to the region. Now, let's get into the second part of the discussion, which is about future plans for deepening connect schemes and also multiple channels of accessing mainland wealth. MSCI A50 Index Futures Contracts, as you know, was launched in mid-October. It was an instant success. I mean, I think it's products of this kind with this launch is so successful that it really solidified Hong Kong's position as a risk management center. This is a good start, but what's more on the offering? I mean, a number of you have spoken that Hong Kong offers the right ecology, the professional services, the products, the infrastructure, and of course, the regulatory cooperation in the region for you to do your business. But I think we cannot be complacent. So let me start with Rico. Rico, as the regulator supervising our market, you have helped shape the development of all these highly successful connect schemes. Can you share your thinking and updates on these developments, including the renminbi dual counter trading of shares, and explain the role that Hong Kong may play in helping the institutional international investors manage their risk exposure to China assets?
Okay, thank you, Julia. I think this morning many speakers have talked about Stock Connect, Bond Connect, Wealth Connect. I think the combination of different connect schemes has provided a very good access channel in Hong Kong for the mainland market. So I would say that Hong Kong now is playing a very unique role as an IFC, i.e. connecting the mainland financial market with international investors. I think we all agree that the Connect scheme are a great success. But before I share some potential new development with all of you, I would like to use the Northbound Stock Connect as an example to further explain how the Connect scheme is important to us, and so hopefully I can give you another perspective. Now, this chart, as you can see, this chart has compared the Hong Kong market turnover, the blue bar, with Northbound trading, the green bar. As you can see, during July to October this year, the average daily turnover of Northbound trading, including both buy and sell, was about 161 billion, which is equivalent to about 62% of the Hong Kong stock market turnover. So that means the Northbound trading now is already very large relatively to our home market turnover. So in view of the Connect scheme, I think there is a lot of the potential for Hong Kong to further develop our market. Now, today I would like to share with you some two major potential developments. First is the Risk Management Center. The other is the renminbi counter. Firstly, the risk management center. With the implementation of different connect schemes, I think Hong Kong can develop to become a risk management center for the mainland market. As mentioned by Julia at the introduction, the accumulated net buy of Asia full stock connect is now over 1.5 trillion RMB. So given the large size of the Asia investment, risk management tools are needed in order to better manage the portfolio. The recent launch of the MSCI Asia Index Futures by the exchange in October is a very good starting point, showing that there is a strong demand for Hong Kong to offer hedging tools to the industry. I think going forward, as the mainland market will further open up, the role of Hong Kong as a risk management center should be very critical. If we can offer more tools to the market participant to better manage their investment in the mainland market, then they will have more confidence. And in the longer run, this will facilitate the long-term capital flow into the mainland market via Hong Kong. So I think this is very important for us to establish the risk management center. And the next question is why Hong Kong? I think as an operator of different connect scheme in Hong Kong is in the best position to act as a risk management center, providing synergy for the market participant. Okay, so this is the first thing I would like to update all of you. The other one is the renminbi counter initiative. When we look at the connect scheme, I think we always, in most cases, we focus on the northbound. But I think we also need to think about how we can improve the southbound and to further develop our Hong Kong market. We are now, the SFC is now working with the Hong Kong MA and the Hong Kong EX on a feasibility study to promote issuance and trading of renminbi denominated securities in Hong Kong. I use the word promote because currently there is no regulatory barrier for issuers to raise funds in renminbi, and there is also no barrier for them to set up a renminbi counter for secondary market trading. But as we all understand, in Hong Kong, we only have a few renminbi denominated products available for trading, and the trading volume has been very limited. So that means it seems that there is no demand from both the issuers and the market participant to use the renminbi counter. But in our view, we believe that if we could establish an active renminbi counter market in Hong Kong, it will help strengthen Hong Kong as a leading offshore renminbi center. It can also help speed up renminbi internationalization. So I think this is a very useful initiative. And apart from the Hong Kong market itself, if we could have more renminbi counter available, it could also improve the southbound stock connect, because as you know, the mainland investor will not need to convert their renminbi into Hong Kong dollar for the secondary market trading. They can use their renminbi to trade the Hong Kong listed securities. But although there are lots of benefits, but I think, as I mentioned earlier, there is no impediment to the use of renminbi counter in Hong Kong at the moment. So our initiative is, to some extent, is not straightforward. What we are trying to do right now is to consider what we may be able to do to change the appetite so that the people may reconsider developing renminbi counter in Hong Kong, and then investor may also more willing to use renminbi counter. So at this moment, I'm afraid that I'm not able to tell you all the details because the study is still underway. But I hope that in the very, very near futures, I will be able to talk to you about all the details of this initiative. Thank you.
Thank you. I can't think of a better person to ask than Haizhou on this because I think, as Rico repeatedly said, there's no policy or structural barrier for renminbi counter to develop. And I would like to ask whether you think that the time has come from the mainland investors' point of view when they are trading southbound. Wouldn't you think that they will find trading and pricing in renminbi more efficient and less costly? And also from a issuer point of view, those you've taken to listing in Hong Kong, what are the concerns? Are they worried about fragmentation from markets if they start a renminbi counter?
I do think I agree with Rico. I think that Hong Kong does have certain advantages in developing its renminbi market, including renminbi counter. I think that it's also a great idea for Hong Kong to develop itself as an important international risk management center. On both, I think those are very important initiatives. Hong Kong is free market, and basically that regulator yourself, I think that are very supportive for local market development. So for that reason, I think that it's far easier in the Hong Kong market to for financial institutions to develop, like Citi or JP Morgan or maybe CICC to develop hedge instruments. I think that for exchange rate market, I think that they lacking of hedge instrument has been, I think, is still a major hurdle for the onshore market in Shanghai. So for that reason, I do believe that Hong Kong has a certain niche. Related to that, of course, if we think about the renminbi exchange rate, the key counterparty would be renminbi to the US dollar, and then of course, second most important currency is euro, and locally is the Japanese yen. On all that, I think that in all the exchange, I think it can be freely conducted in Hong Kong market, and so I think that there are a lot of top institutional players, including the two representatives in the panel. I think that so I believe that in terms of the pool, the liquidity, and all that, I think that Hong Kong has a very important niche. In terms of the preference of the Chinese investors, I think that Chinese investors now, of course, benefit enormously from Hong Kong Shanghai Connect, north southbound, and Hong Kong Shenzhen Connect, north and southbound, and the QD in a way, or in a way that some Chinese institution can invest in Hong Kong and the other markets through QD scheme. So far, not so much on exchange rate, but I think that but this is to some extent is an endogenous problem. It's like a chicken and egg. If Hong Kong takes the initiative, push itself into this market, and that's a lot of service needed and are still not available in the onshore market. I believe that there's a lot of hope for Hong Kong to develop itself as a major international risk management center and the renminbi counter market.
Thank you.
Let me stop here.
I was on a similar model. We always build ourselves as the super connector, or super in terms of stock connect or bond connect. That is, you trade through the infrastructure of Hong Kong. But a normal market opening, the capital market, when it's fully open on the mainland, they will welcome and they will allow direct participation. And the fact that foreign banks like yourself, JP Morgan, are starting to have your own, and you're a broker, and you are able to underwrite, and you are also doing the direct business. So is this model of connecting through Hong Kong sustainable, or we see that the futures market, commodity futures market, actually allow direct trading through brokers, or through having a membership at the commodity trading platforms? So would that be the way to go? And this connect role, is it as sustainable as we think that it is?
I believe so, Julia. The reason why I think that the direct access route, which is now developing, and it's important that it develops further in that sense, is still relative, and I'm talking about foreign investors now, is still relatively difficult and complicated to actually exercise. In that sense, the connect both the Bond Connect and the Stock Connect are great route to access the capital markets of the mainland. And I remember when, in my previous jobs, when I was still running markets in the region, one of the last things that I did was go around seeing investors to discuss the various available routes for accessing the capital markets onshore. And you have the QFI, RQFI. In the bond market, you have CIMBM onshore, and then you have the Bond Connect. And naturally, all of them gravitates towards the Bond Connect because it's easier, it's easier to understand, it's easier to execute, the FX component, it's easier to handle, and so on and so forth. So while we are building onshore presence, I don't think that that will replace the role of Hong Kong, and which I said at the beginning is entirely symbiotic, and the component of the connects.
Yeah. While I have you on the microphone, JP Morgan seems to be pursuing a multi-pronged strategy as far as accessing the onshore wealth. You have a very successful MRF, mutual recognition of funds, selling on the mainland. You want, I hear from Dan this morning, you want loosening, which we are working hard on. You also have intent to have 100% owned management, as a management company, and you're also buying 10% of a bank for distribution, I assume. So can you explain your strategy?
Yeah, so the strategy for the mainland is similar to the way Angel described it. It's based on a variety of approaches. On one side, there is the typical inbound business, i.e. foreign investors, multinational corporations that are coming into China via Hong Kong in most cases, and our job is to support them, which is where we have most of an edge, i.e. clearly the cross-border flows is where we can offer something that maybe the local competitors onshore are not as strong as us. On the other side, there is the outbound business, which is Chinese clients, it could be Chinese investors, it can be Chinese corporates who are going offshore, and again, in that cross-border pieces where we offer our services. And then there is the domestic business, which for us it's obviously nascent and it's small compared to CICC or any of the other big local players. In that sense, the only place where we are starting to engage more on the retail component is actually asset management onshore in China. In that sense, it's the first step into the domestic business. Contrary to Citi, we are a wholesale player in outside of the United States. In that sense, CIFM, though, which is our asset management company in the mainland, is what's gonna get us closest to retail in the mainland. And buying 10% stake on China Merchant Bank Wealth Management arm is part of the strategy of developing further the domestic business, which has also a leg into the Wealth Connect into Hong Kong.
Yeah. Citibank is a powerhouse of distribution of wealth products here in Hong Kong. You have an onshore, but you also have an onshore wealth management team, and now you're investing in GBA Wealth Management Connect. Can you tell me the game plan? I mean, you have exited the consumer banking business too.
Thank you, Julia. First of all, I think, when we talk about the Wealth Management Connect scheme, it serves very different purpose, than the institutional Connect schemes that we just talked about, the stock and the bond connects, etc. And I would like to compliment, the regulators to, get it done, get it through the finishing line, because it's actually very complicated, in design and, serving a lot of different purposes. But I'm so glad that, we pull it off. We are actually very big, in looking at the GBA opportunities, especially through the Wealth Management Connect. Because, as I said, the purpose is very different. Let me talk about the southbound. basically, we are helping the mainland individual investor, retail investor, to diversify their asset allocation. Currently, 80%, around 80%, of the mainland investors' asset is in property. And then the rest probably is in stock market. That's it. What we can achieve, as an industry, through Wealth Management Connect is to help the individual investor to diversify. And what's best, to diversify into the Hong Kong market is because, as I mentioned before, we have the breadth of the product, we have the depth of the market, we have a group of very professional bankers, to service them. And Rico could talk about risk management, I think in the WMC, also, help, in risk management because, all the advisory, done in Hong Kong, all the due diligence of the products done in Hong Kong probably, has given, the investors a lot of sense of comfort as well. So yes, we are actually working on capitalizing and capturing, the opportunity of WMC. You ask how, and the way that we do it is we actually partner with a Chinese bank. As you can read from the news, that our partner is Guangfa Bank, who we used to have a very good relationship before. We have an equity stake, in them before. So we know each other, and also, most importantly, is Guangfa Bank has presence, in all the 9 cities, which is actually quite just a few of the Chinese bank, has that advantages. And they have 290 branches, which if you ask me to build it from scratch, by city is almost, impossible. So I think Guangfa is a very good partner of us, and, I look very much forward, to have a fruitful partnership with them for the long.
Tell us something of your experience. Now it's been launched for a little over a month. What are your difficulties now, apart from the regulatory hurdles that you have to navigate through?
I'm about to set that.
We are painfully aware of that as well. We put out those 40 pages of guidelines.
So I guess I'm not allowed to comment on that 40 pages of guideline. I think, top of my mind, and it is shared, with our partner as well, is we have to invest our time and our thought process in how to educate individual investor. Okay, both in Hong Kong as well as in mainland China, because this scheme allows them to go into a different market, and the market landscape practice is very different. The expectation on return of investment is also different. So I guess, the biggest and top priority and concern as well is for us to make sure that we have all the education done, okay, before we provide and sell the products to them.
That's a very good place to start, because I am fully aware of because it's COVID and because of the licensing as well as regulatory requirements, the amount of flexibility is less. But if it's about investor education, if it's about fund managers in Hong Kong or banks in Hong Kong wanting to educate their GBA prospective clients or clients, if they've become your clients, it's possible to do it. We have said it in the 40 pages guideline that you are allowed to provide, like those banks in Hong Kong are able to provide a set of information about the kind of products, as long as it's not product specific. Like you can say, oh, there's money market funds and the kind of risks and returns that they're producing. There's a lot of misunderstanding, but I just use this opportunity to clarify. If you go through the small prints of those 40 pages, you'll find in the FAQ 28, that's what you can say and what you can educate. You can actually hold a Zoom seminar with your clients.
Rest assured that there is no misunderstanding, and we will do that. We will do that. It will take some time as well, for us to make sure we have the right language and we talk to the right audience.
Right. Now we're moving to the last part of the discussion. In a SFC regulatory forum, we don't talk about opportunities and strategy without discussing risk and how you manage those risks. So in the last few years, we've been through COVID-induced market and operational issues. You have geopolitical risk and you have sanctions risk. And lately, the risk of regulatory risk as well as the risk of, we talk quite a lot over lunch, they're losing talents. So in the last few months, Chinese authorities have tightened regulation on data security, cross-border data transmission, internet companies, etc., all for good reasons. But these rules have, when they come together and in very rapid series, seems to be hitting certain sectors like property, education, and most of all the tech sector. So in this last round of questions, I'm going to ask you to name the biggest risks you see in 2022. And starting with the regulatory risks, so I like to go to Haizhou. And we've seen some pretty powerful policy initiatives from the mainland. As a China headquarter company, can you provide our audience some insights into navigating such risk? And do we expect more of that next year?
Well, I believe that we are in the risk management business. We are all like SFC. You are also in this area. So I think that there are always risks there in the future. As of now, for this year, as you mentioned, that not only in mainland China, but also in Hong Kong and in New York market, let's say, some sectors, China-related businesses in particular, had to face certain risk. Some of that is originated in a regulatory change, a policy change, as you mentioned, in data protection platform and related to property, and so on and so forth. And certain sectors, including property, education, and some part of the technology platforms, I think that the valuation in terms of stock market suffered in some cases a huge loss. I think that in terms of the policy initiative, in terms of direction, as you mentioned, I think that the policy will mean to address certain problems in development in those areas. Including anti-monopoly, including data protection or privacy. I think that it's all. I think that mean to solve the problems. Some of the problems exist for quite some time. I think that the market participant did not really expect the policy coming. So that's why that. Part of the problem, I think, is always expectations. What can be expected? If the market could expect well or about what's coming, I guess that the risk can be priced in well, and the risk can be treated well, and some of the risks can be diversified. And that's another reason I mentioned in discussing renminbi business in Hong Kong. I think that hedging instruments are very important. So in some of those market corrections, I think that there were not enough hedging instruments for market participants to handle the risk. Even in some cases, I think that the policy makers in China had, I think, alerted the market way in advance, but for all kinds of reasons that I think there was not enough, pricing effect, so that the market took as a surprise in some cases. As I mentioned, that the risk will always be there, and every year we'll talk about the risk, and there will be new risk. For next year, I think that I do see some upside. Let's see, risk or not risk. Let's say that a good move or potentially that would help not only stabilize the market but also support the market to grow. One, of course, I think that if you think about it from China's perspective, from macro perspective, I think that the PPI risk in China is fading. And I also believe that the growth rate in China will stabilize. I think that the Q4 growth rate in China is something that the market talked about, or some participants in the market are worried about. We are not so worried. And into next year, we believe that China's GDP growth rate for next year will be probably somewhere close to 6% or way over 5.5%. And related to that, of course, globally, I think that we also think that the inflation risk in the US market is fading. My personal view on this is probably more optimistic. I think that even in the end of Q4, we are going to see probably a significant reduction of inflation risk in the US. So I think that the market has started to rebound on some of the sectors, including on property and education. So I believe that together with a good policy initiative, with good management of policy implementation, and also that with a supportive environment, I'm not so pessimistic about the market for next year. Actually, I think that I believe and hope that the next year's market will be better than this year for both Hong Kong and also for mainland China.
Thanks, Haizhou. For Angel and Filippo, I think the last 2 years we've been through quite a lot. And I think this morning, one of the message Haizhou just had is also communication, better communication with the industry will at least work on the expectations. Now, one of the things I know both of you have done quite well is communicating between your head office and some of the things which happen in Hong Kong, the geopolitical tension, the risk. And I think this morning's, there is a panelist also said, this is a role which Hong Kong does very well, is communicate between mainland and US. We do understand both markets. And I think you both have done quite a lot in the last 2 years. Can you take us through some of the risks that you have managed and continue to manage, and also the role of your communication?
Ladies first.
Okay, this one, ladies first. Thank you, Julia. Yes, in the last 2 years, there are many night calls for me to communicate with the headquarters. But I think, every night worth, a lot, because if you rely on the people reading the news from the media, it can be very scary. And there are a lot of, and you mentioned that, fine prints, in everything. And it actually takes somebody on the ground to be able to explain, what is exactly happening, as well as, what is the risk coming with it. I think, one of the things besides communication is the operating principles, during this difficult time. Which I think is very important, and Citi runs 96 countries in the world. So if you ask me, geopolitical risk management is pretty much BAU for us. We are in Africa, we are in Latin America. Obviously, we are dealing with geopolitical every day. The operating principle has to be our people come first, our staff and clients, how to protect their interests, how to make sure that we have a very transparent information and communication to them. Secondly, is stay neutral, in politics. We are a business, we are not politicians, so we have to be apolitical, in wherever that we run our business. And thirdly, I think it's also very important is to manage stakeholders. So internal stakeholders is the questions that you asked me, but also there are a lot of external stakeholders, even on the ground. I represent Hong Kong, when I talk to my headquarters, but also I represent my business, as well as the views of the U.S. when I talk to stakeholders in Hong Kong as well. So I think stakeholders management has to be a very important risk mitigator as well.
And Filippo, how many midnight candles have you burned?
This week, a few. So Angel said it perfectly. That's part of what part of what our job is, and part of what we need to do is to explain the uniqueness of Hong Kong in that sense. And that's when I think why I believe that people then for instance, in our headquarters, then ultimately they listen to what we have to say here. I did part of that job also, and you remember that when I was chairman of ASIFMA, I did that for 19 and 20, so the Hong Kong protests and the beginning of COVID. So I kind of got used to it. In terms of risks, apart from the ones that we've just mentioned, a few that are on the back of my mind, and maybe it's not next year, but it's in the future is coming. One is the market fragmentation, i.e., if the markets become even more fragmented because of local rules and regulation, it becomes more difficult for us to operate as a hub, obviously. Data localization, it's a bit of a trend that is happening around the world, but is happening in Asia Pacific as well. Talent, for obvious reason, acquisition, retention, replenishment, we have spoken at length about the quarantine-related issues. Finally, one risk that we see, that I see and related to talent is inflation. I.e., how many of our folks nowadays remember when dollar rates were above 5%? Not many people have seen them. So how will we deal in an environment where maybe inflation will come, or I mean, inflation is there, but whether it will remain more permanent than we think, if rates go up, how our people will deal with that? Some of them have never seen it. So those are some of the things on the back of my mind.
Regulators always have the last word. So, Rico, as the Chief Risk Officer of Markets, your last word on all these risks.
Okay. In the interest of time, I will keep it short. I think, as we mentioned earlier, Hong Kong is an IFC and also a gateway to the mainland market. So Hong Kong is now in a very unique position and has been significantly affected by the changing relationship between China and the US over the past years. So as a regulator, I think we all need to better prepare for the geopolitical risk. And the geopolitical risk is a very important risk area that I think require more and more preparation. And I fully understand that for international firms like JP and Citibank, they have a lot of experience in dealing with geopolitical risk. But in order to minimize any negative impact on the Hong Kong market, we need better preparation from all the financial institutions in Hong Kong, including the smaller one and also the key market infrastructure operators. So they need to better assess the potential implication on their operation under different scenarios, and then prepare a comprehensive contingency plan. And as for SFC, I think we have encountered a different situation over the past year. Sanction is one of the examples of the geopolitical risk. As SFC previously indicated, that our regulatory approach will not change as a result of any political risk. So for the financial institution, we expected that they properly assess their own business risk, legal risk, commercial risk, and if they need to do anything in response to sanction, they need to keep in mind that kind interest should be the top priorities. And I think the last point I would like to make about contingency planning is that my own experience is that when we prepare any contingency plan, if you have a plan to deal with a scenario, then in most cases, the scenario will not occur in your real-life situation. So I urge you to have a contingency plan as comprehensive as possible. Thank you.
I still remember the contingency plan that we did together, and we did have to burn quite a few nights candle in order to get that out, but nothing happened. So that's good. So it remains for me to thank all of the panelists for their insights and wisdom, and all of you. I think we had we put that is as we always do. We put issues on the table and we discuss it. So thank you very much.